For the vast majority of people, the information in this chapter of the presentation is going to have a bigger impact on your retirement income than anything else you could do, provided you implement the things that we cover. We're going to show you how to get the most income from your assets in retirement by using the rules about taxes and Social Security income to your benefit. Start by understanding how Social Security income works for you, whether you're single or if you're married. You can start receiving benefits as early as age 62, or you can defer those benefits up to age 70. These are the average and maximum amount benefits in 2019. For most people, Social Security will be a pretty large portion of their retirement income, so you need to be thoughtful about how you claim it. First, you're going to want to establish the primary insurance amounts for both you and your spouse. Go to www.ssa.gov and find out what the primary insurance amount is for you and for your spouse, and at ages 62, full retirement age, and age 70. This shows when you reach your primary insurance amount based on when you were born. It also shows that you get incrementally less income when you take the benefit before full retirement age and more when you take it after full retirement age. Now, if you're married, it's important to understand that the surviving spouse receives the larger of the two incomes. So when one of you dies, the other one gets the larger amount. If you can defer one, you can largely offset the loss of the other at the first death. And you see how taking income at 70 almost doubles the amount based on taking it at age 62? Let's just use a quick example of husband and wife, both age 62. And at 62, her insurance benefit is $2,000 and his is $1,500. If you started taking hers, receive the $2,000 when she's 62, and at age 70, start taking his will have grown to be $2,500 or more. Whichever one survives gets the larger benefit until they pass away. This slide provides some detail as to how those income increases are calculated, and once you start collecting, it's guaranteed for life. And, other than the spouse continuing a benefit, it is guaranteed to be over when you are collectively dead. Now, we often help people defer taking Social Security, but we sometimes get the argument stating that waiting is a bad idea, and we understand that. Now, this chart shows that total income breaks even at about age 81 if you wait until age 70 to collect. It breaks even at age 77 if you wait till full retirement age. If you're single and you're a man whose health is questionable, taking the money early makes some sense. But if everybody in your family has lived to be 90, it's probably not a good idea. Like in many things, when you're married, this process becomes far more complicated. Now, when you've gone to the Social Security Administration website and written down the benefit amounts for each of you by age, if there's an age difference between the two of you, you should also track it by years. If one of you turns 62 in year 2021 and the other in 2026, track income on that scale as well. You're going to need to look at health and gender factors. Women generally live 7 years longer than men. If everyone in your family died before age 70, it should affect the order in which you take income. Now, normally, one of you has a higher level of income, and one of you will outlive the other. From that, you can figure out whose income should be deferred the longest, for the benefit of the survivor. There's also the overriding question of continued employment. Now, will either of you want to work beyond full retirement age, or even beyond age 70? That needs to get factored into the equation as well. If, after you've done some homework, and you're still struggling with this, or you would just rather have someone else do it, feel free to give us a call at the number either on the beginning or the end of this presentation. Now that we know something about Social Security, we can start to make decisions about who receives it and when. Now, if you don't have any assets to supplement your Social Security income, you need to think about how long you can continue to work and whether or not your income level can be managed to have collecting Social Security while working make sense. This requires understanding different rules, and it's covered in the next section in more detail. You need to figure out an approximate retirement date, or year. You will want to understand when you want to start collecting Social Security income, which may be before, when, or after you retire. There's a lot of money riding on these decisions, so take some notes and think it through. Now, if you have assets to supplement Social Security income, or are still accumulating those assets, it's time to look at what you have, how it's taxed, and its risk relative to the larger market. You may need to get your mind around decumulation. Some folks will never outlive their basic income, and others will spend money like they will never stop printing it. But some simply can't spend money on themselves. They have spent their entire lives saving money. Spending is not something they do well. Regardless, we must consider that we may get to a place where we have to spend the money that we saved. There are two fundamental approaches to harvesting income. One is the bucket approach, where you allocate assets into different risk, timing, and taxation components to be harvested based on a variety of circumstances. For people with excess assets, or assets that are all tax all the time, like a 401k, simply establishing a percentage to withdraw each year can make sense. There are formulas for determining how much that would be based on how many years of income is needed and how much money is likely to remain. Again, if you haven't already done so, you're going to need to create a spreadsheet using ages and years and Social Security income. Add another section using the kinds of money you have, its taxation, its liquidity. From there, you can label the current level of risk each group of assets has and when or if you would harvest them. By now you can see that intelligent planning and positioning will make a big difference in your lifestyle. During the years between retiring and collecting Social Security, you can use some combination of your assets to provide income while controlling taxes and risks through selecting assets to be harvested based on whether the market is going up or down. Everyone has different options and needs, so it's hard to illustrate here. But experience tells us that this could be an extremely impactful process. The next chapter breaks down how Social Security income is taxed, and we expand on these harvesting ideas there.